So in the last video, we looked at our depreciation schedules for the dump truck, and we did the straight line method and the units of production method. So now we want to take a look at the double declining balance method. Your workbook just calls it the declining balance method, so it can be called either. So again, we want to start with the year. So we could just copy that down from here. Now, one of the things with the double declining balance method is that we don't consider the residual value until the end. So we're going to start with the cost. So the double declining balance method can be a little tricky, but the idea behind it is to have as much depreciation expense in the beginning of the life of the asset as possible. And the purpose of that is to encourage companies to buy more assets. So that's why the government allows this for both book and tax depreciation. So it benefits a company because it gives them a high expense and lower net income, and therefore lower taxes. So this is used primarily for tax purposes. So essentially what we're going to do is we're not going to worry about the residual value to the end, as I had said. So we're going to start with the cost, the 64,310, if you recall up here. Okay. All right. We're not going to worry about this until the end, as I said. Okay. So essentially, what we're doing for the rate is we're doubling the straight line rate, which is why it's called double declining balance. So if we go back to straight line for a second, we didn't do the rate there, but it was 10 years. And if you remember, straight line is essentially taking the same amount of depreciation expense each year. So in this case, it's 1/10 of the depreciable cost per year. So if we're going to double that, it's going to be 2/10 or 20%. So the rate for double declining balance is going to be twice the straight line rate, which is 20% or 0.20 in this case. So our depreciation expense is going to be the beginning book value times the rate. That can also be referred to as old book value. So we can see we have a lot of depreciation in the first year. So again, that was the beginning book value balance times the rate. Okay. So if you compare that to units of production, much higher. Straight line more than double. Okay, because we're not using the depreciable cost minus residual value, we're just using the cost. Okay. So of course accumulated depreciation would be the same, and our ending book value is going to be cost, right? 64,310 minus accumulated depreciation. Okay, so before we go on, let's do our journal entry for the first year depreciation expense under double declining balance. So again, we're going to use the same accounts, same date. The difference, however, is going to be much more depreciation expense than we had under the other two methods. Okay, so it was 12,862. Okay, so under double declining balance, we're essentially uploading the depreciation expense into the early years. Now, what gets a little tricky here is when we do the depreciation expense for year 2, in this case 2020, we're not going to use the 64,310 again. What we're going to do is we're going to use the ending book value from the previous year. Okay, so instead of using 64,310, now we're going to use 51,448. This should all be currency too. No, it isn't. Make the decimals. Okay, the rate is going to be the same every year. Okay, so we already know the depreciation expense is going to be the beginning book value times the rate. the accumulated depreciation, just like the other methods we did, we're going to take the previous year's accumulated depreciation and just add it to the current year. So just like we did in the other two methods. And again, we know that ending book value is going to be cost minus accumulated depreciation. Okay. So as long as we've done our formulas properly, we can copy. So let's copy everything down here. Now, one of the problems with using double declining balance is that when we get to the end, sometimes we're above or below the residual value. Okay, so if you recall, at the end of the schedule, at the end of the useful life of the asset, our book value has to equal our estimated residual value, which was the 5,000. So this has to be 5,000. We can't go out another year because the useful life is 10 years. So what we often have to do at the end of our double declining balance depreciation schedule is force it to balance. So in this case, even though 8632 times 20% or 0.2 is 1726, we can't leave this at 6905. It has to be 5,000. So what we're going to have to do is we're going to have to force it to do that. So we're going to take the 8,632 minus 5,000. That's how we're going to get this. Okay, so because we know this has to be 5,000. So that's going to be 3632. So we're just going to have to put that in manually. So that's one of the problems with double declining balance, and it can be a little tricky at the end because it's the only method we're not considering residual value until the end. Okay, so that's often what has to be done with this method. Now, the sum of the year's digits can also have some interesting problems, and the reason for that, again, is because it's trying to upload the depreciation in the beginning. So let's copy the year. Unlike the units of production method and the double declining balance method, the rate is going to be different each year. Okay, so it's not going to have a constant rate like double declining balance or units of production. What it does is it adds up the year's digits. So in other words, we have a 10-year useful life. So what we have to do is we have to take 10 plus 9 plus 8 plus 7 plus 6 plus 5 plus 4 plus 3 plus 2 plus 1. You can see why it's a little bit antiquated. And that's going to equal 55. So the 55 now is going to be our denominator. Okay? So the 55 will be our denominator when we do our rate. So that's the only part of it that's constant. So the rate for the year 2019, our first year, is going to be 10 over 55. Okay? Right, so it's going to be 10 over 55. That Excel is going to convert it to a decimal. For year 2, 2020, it's going to be 9 over 55. Okay? For year 3, 2021, it's going to be 8 over 55, and so on. So we would have 7 over 55, 6 over 55. So you can see each year you go, you're going to have less depreciation. 5 over 55. And the idea, again, is to upload the depreciation at beginning years. So 3 over 55, and then 2 over 55, and 1 over 55. Okay, so depreciation expense is going to be simply the rate, okay, times the depreciable cost, which is cost minus estimated residual value. So what we're going to do here for depreciation expenses, we're going to take equals 64,310 minus the 5,000, cost minus estimated residual value, times the rate. Okay, and that would be at B63 in this case. Okay, so what that's going to do is it's going to give us the expense for the first year. And for the first year, it's going to be 10,784. So that's your formula. And you're going to do the same thing for all the rest of the years. Now, fortunately, we can copy it. So you're going to see that the depreciation each year is going to diminish. So when you get to the final year, it's only 1,078. So for our journal entry, we're going to see that again, using a different method, we have a different depreciation expense. So let's go to the journal. And for some of the year's digits, we're going to use the same two accounts. However, this time it's going to be 10,784. And this is going to be sum of the year's digits. So you can see, depending on which method we use, will determine what our depreciation expense is. This one is very seldomly used. Like I say, it's very antiquated. This one is often used for tax purposes. Okay, and these are more for book depreciation, with the straight line being the most common. So let's finish out our schedule. So we know accumulated depreciation in the first year will be the same as the expense. In the second year, again, it's going to be the first year's accumulated depreciation plus the second year's depreciation expense, the same way we did it in the other schedules. So then we can copy that down. And then finally, the book value we know is cost minus accumulated depreciation. So at the end, again, our book value has to equal our estimated residual value of 5,000. And it does. So these are the four methods. Okay, there are some other ones, but these are the most common, with straight line, okay, as the most common for book depreciation. Units of production is used for some types of assets. Double declining balance is very common for taxes, and again, this one's kind of antiquated, but it's around. And these would be the journal entries for each one. We should have the same date there. So thank you again for your attention.